been maxing out my Roth IRA for the last 10 consecutive years. Here's the 5 ETFs that I would hold in it forever. But before we dive into the ETFs, you need to understand why the Roth is so powerful. It's because it's triple tax advantage. So no taxes on dividends ever, no taxes on capital gains ever, and no taxes on withdrawals if you are 59 and a half or older ever. So you could start with $100 and have it grow to $100,000 and you pay no taxes on that $99,900 gain. You could build a $50,000 per year paycheck in dividends and not pay any tax on it. And you can pass that cash flow machine to your children or a charity after you pass away. And as someone who has built a 7-figure net worth and a multi-6-figure portfolio with no prior investment knowledge and no expensive financial advisor, I can tell you with certainty that my Roth IRA is one of the biggest drivers of my wealth in the last decade. So let's get into the 5 ETFs. The first ETF is for people who absolutely hate finance and find it too complicated, and that is a target date fund. You find expense ratios, ticker symbols, earnings reports, if that all just goes over your head or you just don't care about it and you want everything done for you, target date funds are a great way to accomplish this. They're like a one-stop shop in the ETF and investing world. And they work by you picking the date that you anticipate retiring, and the younger you are, the more aggressive the allocation in the fund is, and as you move towards that retirement date, the more conservative it gets. Where do you find these? Well, Fidelity has the Freedom Funds, Vanguard has the Target Retirement Funds. At Charles Schwab, they're simply called the Target Date Funds. It's because it's a set it and forget it. You can pick one fund, set up automatic contributions, and literally not look at it for the next 30. The downside is that there is lower potential upside when compared to a portfolio that you have more control over, and you're also going to pay for that convenience, so they are going to have higher expense ratios than your passively managed funds. The second ETF is a foundational ETF, and I would make this at least 40% of your portfolio. And this should be in an index fund that tracks the S&P 500. My top picks would be VOO, SPLG, or SPY. They're all basically identical. They all track the same index, the S&P 500, and they all should have an expense ratio of lower than 0.1%. This is your foundation because it gives you exposure to the 500 top performing companies in the US, and it's an index historically proven to generate long-term consistent returns. Where I see people run into trouble with this is that they have more than one of these in their portfolio. So you just need one. You don't need to have 2 different things tracking identical indexes. That's like paying for an oil change twice in one day. Just pick one and move on. The third ETF is a dividend or value ETF, and this is your tax-free paycheck machine. This should make up about around 30% of your portfolio. And this is where the Roth becomes absolutely magical. Dividend stocks are cool in a taxable brokerage account, but you are going to pay taxes on those dividends that you earn regardless if you reinvest them or not. In a Roth, your dividends compound tax-free. And the best part is, as you're compounding, you never have to touch the principal or sell it if you don't want to. You can simply live off the dividends, your principal remains intact, and you can pass it on to your kids when you pass away. My favorite dividend ETF is SCHD from Charles Schwab, but other alternatives are VYM, VIG, or DGRO. The fourth ETF is your wildcard position. So this can be safe or risky. It's your pick, and I recommend that this make up 10 to 20% of your portfolio. This is where you get to customize based on your own personality and risk tolerance. Option 1 would be to go with a more conservative asset, such as bonds. And if you want an ETF, a lot of people like the VND ETF from Vanguard. I personally don't love it because it's down 15% in the last 5 years. That's not what I want in my portfolio for my quote-unquote safe position. And because of my age, I currently don't hold any bonds in my Roth IRA. But an alternative to BND would be SGOV or SGOV. This is the iShares 0 to 3 month Treasury ETF. The short-term treasury fund, it's way more stable than BND, generates a decent dividend yield. It doesn't drop dramatically when interest rates change. Option B in this part of your portfolio is you could go extra aggressive. My personal pick would be VGT, which is Vanguard's information technology ETF. It's pure tech exposure, which often means more aggressive growth potential. Other options include SMH or even a Bitcoin ETF such as IBIT. The most important part with this position in your portfolio is that it is something that you need to research heavily yourself and not just blindly trust anyone that tells you what to put into it. The key is that it should be either significantly more or significantly less risky than everything else in your portfolio. And the fifth ETF is your growth ETF or your accelerator. So this should make up about 20% of your portfolio. And it should be invested in a broad growth fund, such as VUG, QQQM, or SCHG. You want companies that can outperform the S&P 500, but you still want broad diversification across multiple sectors. So if I had to start over today, here's how I would reallocate my Roth IRA. 30% SCHG for dividend growth and passive income, 25% VOO for my S&P Foundation, 20% VUG or SCHG for the growth accelerator, 15% in a wild card, either a very aggressive position like IBIT or a very safe position like SGOV, and then 10% into anything else that you want. This portfolio gives you exposure to thousands of companies globally, a mix of dividend income and capital appreciation, both conservative stability and aggressive growth, and tax-free compounding on everything. So if you want to do this portfolio, here's your 4-step action plan. Step number 1 is open a Roth IRA. Step number 2 is set up automatic contributions. Step number 3 is to buy these ETFs in the allocations that we talked about. Step 4 is to not check it constantly. And step 5 is to increase your contributions as you can or as you earn more. That's it. You don't need 47 different funds. You don't need to pick individual stocks. You don't need to have the perfect timing or any complex strategy. You need 5 solid ETFs with consistent contributions, patience, and time. Start today, even if it's just $10. And if you want more in-depth information on this 5 ETF portfolio, sign up for my free weekly newsletter. This week's issue is going to break it down even further. You can sign up for that in my bio.